You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Nice job, guys. Very interesting perspective. And I'm a big fan of the Sox as well. Next up, we have Henry Schwartz and Andy Nybo. Henry's founder of Trade Alert, and Andy Nybo is with Burton-Taylor. Both are here, and they're going to be sharing their insights and views on market trends, what they're seeing, and a broader assessment of the state of the options industry. Please welcome Henry Schwartz.
Here we go. Good morning, guys. Thank you for coming in, and thank you to MIAX and OIC for inviting me back to do another State of the Industry. I have 15 minutes and 15 slides. I'm going to talk really fast. I didn't want to take anything out because I love this data. I think it tells a lot about what's going on in our business, and I hope to teach you a few things. So I'd like to start with a high-level view. This is options volume history since inception for the listed market, about 46 years here. Adding on each new exchange as it launched. You can see things are relatively mellow until around 2000, when the ISE really revolutionized things by opening purely electronic markets, and taking things a lot further than they had been with some of the rays and things that had been pseudo-electronic. Growth goes really exponential, almost from that point onward, in early 2000s, and then kind of plateaus, over the last 6 or 7 years until last year, which was, a blowout year in terms of volume for the industry. It was almost 1 billion contracts higher than the year before, 20% growth, over 5 billion contracts for the first time, which was really, pretty amazing for the industry. And we'll look at that a little bit closer. Looking at current volume this year is on pace for about 4.7 billion, which is a decline of about 6.5–7%. But it's still looking like it's going to be the second best year ever. So I think you have to kind of look at that and say, well, this may be a slightly down volume year, but last year was basically an outlier in many ways. And if we can kind of hold above that 4.5 billion level, that's a healthy sign. Looking with more detail at the option volume by index, ETF, and single stock, and the growth levels. The one thing that kind of jumps out here is if you look at the single stock option volume, which is the yellow bar, that's looking like the third year of volume increases, even going into what looks like it's going to be a down option volume overall year. So to see single stock volume really rebounding, continuing to rebound, I think is a really interesting and a really positive development. You see index and ETF declining. And one factor I know that's going into that was mentioned at a Credit Suisse conference last month in terms of how hedging worked out for some of the buy side last year, which is not very well. And there seemed to be a lot of complaints about how the hedge performance in December, using index options particularly, didn't really protect these funds from the decline that we saw. And on top of that, what you have now going on is a lot of these funds put some money, moved some money into cash into January because they're expecting redemptions after a bad year end, and now they're chasing performance. So they're going to do that with leverage in the single stock space. This is what I call the size of the pie, even though it's not a pie chart. This is volume and theoretical edge, and we calculate edge based on the difference between the trade price and the theoretical value, which we source from FT options, and sum it up. So if you look at just March, basically an average day last month, you had about 10 million contracts in single stock space with about $36 million of kind of gross edge. Now you have to discount that in terms of the realized edge for the liquidity world is probably about 80 or 90% discounted. So, but if you sum that up and then index is $16.5 million, and the ETF world is 13.7 million, so you got about $60 million a day on a typical trading day in March. That, if you annualize that and you discount it, like I said, you get about $2 billion a year in kind of the size of the pie for the liquidity providers. So that's kind of why many of us are here. Market structure. I'm not a market structure expert. I've given up on trying to be one because it got too complicated. There's a change versus last year, which is we have the MIAX Emerald exchange, which launched this year and had a very smooth rollout from a handful of names to several hundred of the top names. You have 5 operators. You basically have 3. You have maker-taker, PFOF model, and then you have these hybrid models. So 16 exchanges now, 5 operators. What I've been told is that there's kind of 3 viable models, but there's tweaks you can make on the hybrid, and there's nothing to keep a couple more exchanges from popping up especially with the operators that don't have kind of all 3 models. Market share over the last 13 years or so. This is all 16 exchanges. That little tiny sliver yellow at the top is Emerald. What you see here is going from 5 exchanges, because this is when ICE and BOX were the new guys, to 16 exchanges. And what I see on this is a pretty impressive kind of fragmentation, so that more or less every exchange is getting a pretty reasonable part of the market, and is in general is viable. If you look at it in sense of by the operator, so the 5 big operators, it's a little bit easier to see what's going on. That Miami Holdings is the yellow line. The title's moved a little bit. You see pretty actually, and I'm not saying this because they invited me to talk. That's pretty impressive growth for MIAX to come out of nowhere and get to almost 10% between their 3 exchanges. And looking at this, it looks like it's kind of coming out of the NASDAQ family of exchanges to some extent. But kind of this is the dynamics of what's going on. Concentration, we revisit every year. These are the 100 top names and what part of the market by volume they make on average. This is for March. Everybody knows we have a very kind of top-heavy market. Last year, it was 103 products made up 80% of the volume. So there's about 4,300 listed underlyings. So you're talking about 3% of the names doing 80% of the flow. This year, it's actually a little bit better. It's 133, or in March at least, it's 133 products making up 80% of the volume. So that actually, that breadth widening out, is something I think that's actually very positive. Listings. This was touched on yesterday in the exchange updates. This listing proliferation, the strikes, the weeklies, actually gave us 996,000 tradable instruments in November, and that was an all-time high. Even though every year we talk about what are we going to do? There's too many listings, because this creates a big drag, a big cost for liquidity providers, adds a ton of complexity to the business. And so, when you see the yellow line is the actual number of underlyings, that's not going up. We've listed a few more things, and with some of the recent high-profile IPO type of openings, Lyft and Levi's and Uber and things, there's action there. But this, quoting 1 million contracts on 16 exchanges is incredibly expensive and entails a lot of risk. And when we looked at the data, there were about you could delist about 200 underlyings, and none of them have any open interest or volume to speak of to get started. Market quality, and this probably plays into the complexity and proliferation of listings affects this. So this is the top 25 names. The blue line is the spread that's paid, basically, and the orange line is if the buyer paid the full offer or hit the bid. And so the difference between them is the level of price improvement, and that's a nice consistent level. The one thing that that you see though is 7 years ago the markets were a little bit tighter than they are now for a similar level of VIX, which to me it makes sense if markets blow out when the VIX is high, but you'd kind of expect those markets to tighten back up, and that doesn't really seem to be happening, even though VIX has come down. In fact, if you look at the bottom 100 of the S&P 500, these are names that average daily volume is kind of in the 500 to 1,000 contract level. One thing you see is that the spread that people pay is about 5 times as big. So here you see around 2 cents is kind of the average, and here you see 10 cents. But the liquidity in these names is, and this was mentioned just in the last panel, is not good. And the banks will tell you, well, there's plenty of price improvement. If they call us, we're happy to make a mid-market quote. But the reality is that there's plenty of people that won't call, and a lot of the new entrants to the market don't have a relationship with, with Goldman, where they're going to call and get a very tight inside market. The other thing that I don't like is this year so far, these bottom names have even gotten wider, even though volatility's come down and the super liquid names have tightened up reasonably. Weeklies and quarterlies, this is one of the the biggest success stories that of innovations in the industry that we've ever had. Since 2010, now the weeklies, and this tends to be just the first 10-day, the first 1 week or sometimes 2-week cycle, is now doing about 30 to 40% of the business. There's days in Apple where weeklies are half of the volume. So you can have a 1 million contract day in Apple and have 500,000 contracts trading in 4, 5, 6-day options. Obviously, in a catalyst like earnings, that's maybe makes sense. But it's very, very consistent, and customers like it, and banks seem to have gotten used to it. What this has caused is this shift to a short-dated focus. If you just look at the blue section, those are your 10-day and shorter trading volume, and so you've gone from about 20% to 30-something%. And if you look at the out to 30 days, that continues, and this has really all come at the expense of the long-dated flow. And I don't think the long-dated interest has gone away from the buy side, from the insurance companies that like to trade those. I think it's tending to move to OTC. At that same Credit Suisse conference I was at, there was a panel with 2 buy side, and one of them said they trade exclusively OTC, and they prefer it that way. And I think that's something the business really needs to keep in mind. I get it, OTC, filters into listed, kinda. But I was told by another bank that everybody they clear gets an ISDA as part of the clearing agreement, and is basically told we'd like you to trade OTC exclusively. So that's a threat. Complex orders, another big success story to go with the weeklies. The orange section is index, the blue section is single stock. Index, 70% of the flow is part of complex orders. A lot of that comes from the fact that in SPX particularly, things are tied to combos because they can't tie it to stock. Single stock, it's kind of leveled out around 30%. It seems to be kind of the saturation level. One thing that's coming later this year, which is nice, is Opera's revamping the condition codes, which help people understand, help people like us understand as much as possible about structures that are trading, and also the way things are trading. So it's going to help a little bit with spreads tied to other spreads. It's going to help a lot with identifying auction activity. In fact, that kind of, most of them relate to helping see which executions are taking place in the form of auctions. Another area of growth is this cross-asset ETF. So your non-traditional U.S. equity ETFs, things like commodities, gold and oil. Over the last few years, a lot of the strength has come in fixed income ETFs, so HYG, TLT, and the international ETFs, so things like FXI, EWZ. Those, and then the dark blue line is actually the volatility ETFs, which were doing great until they till some of them imploded last year. But I would actually expect those will kind of slowly creep back into the market as well. So, but HYG particularly last year had days that were over 500,000 contracts. That's a big one. Flex options. Sorry, this one looks a little yucky. Flex is kind of one of my favorite little parts of the business. It's one of the more opaque pieces, but we had a record quarter for Flex volume, first quarter this year, almost 12 million contracts traded. There are some big open interest positions out there in Flex. It's a good alternative to, or kind of like a good medium between listed, where there's a pretty decent amount of transparency, and OTC, where there's virtually no transparency. And we talk to the exchanges and try to kind of see what can be done to help that along, because on the data side, Flex is messy, but I think there's a lot of opportunity there. And this, I'm actually on time, is the tag cloud, basically, of all of the participants based on 13F option filings, and the font size is sized by the square of their option holdings. So what that means is, if Susquehanna is twice as big as Citadel, which it is, it means they have 4 times as many option holdings reported in 13F. You got about 700 filers with positions. We track filers quarter to quarter, and it's a pretty healthy, consistent growth over the last 10 years or so. That's what I have. Thank you very much for your time. And now we have Andy Nybo from Burton-Taylor, who will give you a different perspective on the state of the industry. Thanks.
Thank you all, and thank you, Henry, for that great presentation on the industry and the volume trends over the past decade. As Henry mentioned, my name's Andy Nybo. I'm with Burton-Taylor. I'll be talking a little bit today about some of the structural evolutions of the U.S.-listed options markets, why it's changed, how it's changed, and the impact it's had from a technology perspective on the industry, and particularly the market makers. But first off, I'd like to obviously thank the OIC for putting on a wonderful event, and MIAX for their sponsorship this year. Great venue. I'm really looking forward to the speakers today and tomorrow, so it should be a lot of fun. And I'm glad to have the opportunity to talk through what I found in some work I did last year. I talked to about 19 different firms out there in the U.S.-listed options market, broker-dealers, all the exchanges, a handful of routing firms, and 9 market makers. So I gathered their perspectives on some of the industry shifts we've seen, what it means for the market, and the challenges that market makers face operating in this marketplace. So I have a handful of slides here. I'll try and save some time at the end for a few questions. These slides are part of a bigger study I did at the end of last year that we published in January that really dived down into the market making community and how they operate in this marketplace. So I'll talk about some of the drivers, market structure challenges, successes, and then the market makers and what they have to deal with from a technology perspective and how they operate. So there's a lot of words on this slide. It's the only slide with a lot of words, so I apologize, but I think it's going to set the stage, right? So over the past decade, over the past couple of decades, we've seen these major shifts in the marketplace. Changing investor demand. Retail and institutional investors are a bigger part of our marketplace today. They're getting smarter, they're getting faster, they're using more powerful analytics, and I'll talk a little bit about that. Obviously, regulation in our marketplace causes changes in behavior, changes requirements that you need to operate in this marketplace. It makes it much more complex. You have DR, you have CAT, you have all these different things that the industry needs to manage and deal with. And then the fragmented exchange landscape, right? 16 different exchanges does create a few challenges for the marketplace, particularly for the market makers, risk protections, and things like that. Talked a little bit about how the end user community, customers, and institutional investors are using more powerful strategies, more powerful analytics. And it's not just the institutions, it's retail investors. If you look at what a retail investor can get through their online broker, the screening tools, the monitoring tools, what you can do from your phone, It's absolutely a huge change in the industry, and it really changes the dynamics and how the exchanges have to operate. The brokers have to manage 16 different exchanges, routing order flow. They have to monitor data, monitor markets. Any routing firm has to be effectively connected to each exchange. So that raises costs, it raises complexity, and it's really a technology burden on them. I think Henry mentioned before, and you saw the volume explode after about 1999 in the early 2000s when ISE launched the first all-electronic exchange. So that was kind of the beginning of the end for the industry, as a lot of people knew it way back when. I think fast forward a few years, a couple of different circumstances happened. Penny pricing. 13 pilot stocks in the initial penny pilot program. That changed a lot. So instead of 8s and 16s, all of a sudden you're trading options in pennies. It requires more data, more analytics. You have to be faster. You have to monitor the markets. A penny change in the stock underneath it, has an implication across not just one option, but all the strikes across a series, right? Also had maker-taker pricing introduced by ARCA in the options market. That changes behavior as well, right? You want to be first in, first out, last in, last out, depending on your strategy. So you had to rely more on speed, more on technology. I think 2010 was a huge impact on the marketplace with the multi-listing of weekly options. All of a sudden now you have an expiration every 6 weeks in the options markets today. On top of that, you have near daily expirations in the most liquid instruments, SPY and other instruments. That changes what you need to do, how you monitor the market, how fast your technology needs to be. Not only for investors looking and monitoring the market, but the market makers have to sit there and build this technology to support this accelerated marketplace. Some of the biggest market makers are spending more than $75 million a year on maintaining their technology plan to support options trading. That's a huge number. But obviously there is some return on the investment, or we wouldn't have these big firms in the marketplace. And then last but not least, 2012, MIAX launched their first exchange, and that was a big shift for the marketplace. And I think Henry's slide kind of illustrates that. Their market share gained, and a lot of it had to do with the fast, the technology, the speed, the risk controls that they put in, as well as other exchanges developed over time. And lastly here, again, I keep talking about the market makers, and they're the kind of the foundation of our marketplace. They spend a lot of money managing this market structure, and I have some slides that'll talk a little bit about that. But let's talk about some of the good things that this industry has done and some of the wins. So again, I talked to 19 different firms out there about this and asked them, what have the exchanges gotten right? What has the industry gotten right over the past the past 3 years, in the marketplace? Far and away risk protections. Risk protections are a huge, huge benefit to the marketplace. Last year I have a slide that is absolutely incredible to me looking at it, showing how many transaction, the message rates that spiked towards last year, the end of last year. The market makers and the industry is participating on 16 exchanges. Being able to manage that risk exposure across all those 16 exchanges is paramount for market makers, and the exchanges have built these protections and these risk guards that really have helped the industry survive and thrive in terms of their trading activity. The next one's kind of interesting, consolidation. There's 16 exchanges, but now we have 5 holding companies owning those 16 medallions. And the consolidation, when I probed that response, what do you mean consolidation? There's still 16 exchanges. If you have one holding company operating 3, 4, 5, 6 medallions, a lot of the connectivity, a lot of the parameters of protocols to connect to that exchange tend to be similar, and it lowers costs for someone that connects to that exchange. So there may be 16 exchanges, but with NASDAQ, you have 6 licenses, MIAX 3, CBOE 4. Being able to connect and operate on those exchanges is a lot simpler. You only have to deal with one team, one technology team, and interact with one customer service desk. Another good thing that was raised by a number of firms and people I interviewed is the responsiveness and the working together that exchanges are willing to do with the industry. There's been a change in how the exchanges interact with market makers and how they deal with their needs and requirements. There's a sense that the exchanges are really understanding, are looking to better understand what the market makers are doing, and how they operate and the needs and what they need to do. So that was another good thing. Complex order logic, that was highly talked about a little bit, and then a mishmash of different things that the exchanges have gotten right, that the industry has gotten right on this slide that I'm not going to really talk through. So let's talk a little bit about the challenges, right? So capital challenges, right? The capital that market makers need to have, the clearing firms, and how the capital is calculated. And we have, after my little comments here, we have a panel with the exchanges, leadership panel, and we have John Fennell on that, and he'll talk a little bit about that topic. Auctions, internalization, again, that's always a challenge for the industry. It locks up flow and tends to impact the quoting on the lit exchanges. Fragmentation, trying to find liquidity. There's plenty of liquidity if you're doing 5 or 10 lots, but if you're an institution and want to trade in size, the screens just simply can't support it, except for the most liquid options, perhaps, and then near-term expirations. So they tend to pick up the phone and talk to their brokers. Some of that flow goes to OTC, and that's something that the industry should remember. Too many exchanges, too many series, lack of liquidity. Again, that's that fragmentation, a million different options out there that can trade. It makes it a very challenging environment. So this is the slide that I found fascinating. I update this slide every quarter or every half year, and I hadn't updated it until this week for this presentation. If you look, these are the message rates that Opera publishes on their website. And if you look at that spike in the fourth quarter of 2018, 45.9 million billion messages with a peak number of transaction messages in the markets in the fourth quarter of 18. And per second, 19.8 million messages per second, again, in that fourth quarter of 2018. That's an incredible amount of information and market data and just going through the system and having everybody monitor this and manage this and keep track of what's going on. It goes to the complexity of this marketplace we've created. Technology is simply, we rely on that so much. And I do a lot on the market data side at Burton-Taylor, and we hear a lot of complaints about the cost of market data and how that's impacting the marketplace. But with these kind of message rates, with the kind of technology that's required to manage and have redundancy in all these different systems and platforms, market data is expensive, and providing that market data is a challenge for the industry and consuming it as well. So it's definitely a topic that we hear a lot about. So how does this impact market makers? So these responses from the next few slides are specifically for the 9 market makers I spoke to. So, how has this change impacted the industry for the market makers? And, obviously it favors the large players, but why? Because they have the scale, they have the volumes, they have the consolidation operations, where they can direct their flow and use exchanges and reach those volume tiers and lower the pricing. And that's a big part of why there's this consolidation in the number of market makers and why there's only 10, 15, 20 today versus a couple of hundred a decade ago or further. It's harder to make money. When you're competing on speed, the guy with the fastest server, the fastest connectivity, the fastest microwave antenna wins. So that is a challenge that the market makers face as well. On the good side, there's less competition. There's not 200 guys you're trading against in the pit. You're trading against 15 guys with supercomputers somewhere in the Arctic these days. But it's become ultra competitive at that top tier, and you're playing and you're trading and you're really competing on speed. Market makers. I have a slide. I believe one of the next slides is what do you spend your technology dollar on? Some of it's just situational. Depends what we need that week, what we need that day, what we need that quarter. But it's a constant drain on their operating costs. They have to invest a lot of money, as I mentioned. A very large market maker in excess of $75 million a year. A smaller mid-tier market maker is spending $25, $30, $50 million a year on technology to support their operations. And it's not about innovation. It's not about having newer tools that are innovative in terms of what they do and how they work. It's just managing the cost of this, right? You can hire the rocket scientists, you can get the fastest server. It's just managing the cost, competing against Google and Facebook to hire a quant guy, right? Who wants to work for a market maker when you can work for Google and wear shorts and hang out in California and do all that and tell all your friends you're at Google, as opposed to working for some initialed firm in Chicago that your friends and buddies at college never heard of. So there's that kind of, you compete for that talent, you compete for those PhDs, and that raises the cost for market makers as well. Market data, exchange fees, everybody loves to complain about costs, right? It's the cost of doing business. But that is really what they're worried about, is all these constant investments that they have to make in the technology to just to remain competitive. And then the last two I'll probably mention there. It's a speed race in this marketplace, and a number of market makers are very concerned about being picked off by some of these opportunistic liquidity takers, right? The news algos, the firms that are rely exclusively on having access to the information fastest, acting on that information and then stepping away. They don't have to put two-sided quotes up there. They can, opportunistically go after that liquidity when they have an edge in terms of information. The other question I asked, so when you quote on an exchange and when you're going after liquidity or you want to provide markets, what are the most important factors you evaluate? Obviously, speed of the exchange and the how the platform works, how deterministic are very important, but it's also situational. Oftentimes it depends on the strategy of the market maker, what they're trading that day, what their positions are, what they want to be in, what they think is going to happen. They may leverage market structure, maybe the volume tiers in an exchange they want to meet at, so they'll incorporate that. Equity rights programs do drive some volume to exchanges, but you have to tend to be a bigger firm, a bigger market maker to really get access to that, to the critical mass to earn out that equity. Exchange technology is also important. And I looked at this slide this morning, critical. Something's really critical. I don't know what it was. 22% of the respondents said that, but I looked it up. It's speed, right? Speed is critical for these guys. So all these different things are very important for the community. Finishing up here, so, as I mentioned before, market makers look at what they need. It's cyclical, their investments. It's situational with what they need. It depends on the marketplace, what's changing, what's evolving, what new regulatory mandates are coming down the pipe. So it is a lot of different things that go into the mix. But the bottom part of the slide kind of shows you where their costs are going out. Market data, it's personnel, it's colo and cross connects, and it's just connectivity across those 16 exchanges. So it's a very complex trading environment. Technology is incredibly important to the market making community as well as an industry as a whole. In a moment here, we're going to have the exchange leaders out here, and they can talk about how they view the world, what they think the wins and the challenge we face as an industry. I think I have time for a quick question or two, but if no one has any, I will move on here. Any questions? Great. Well, I'd like to thank you all again, and again, thanks to OIC and MIAX for that.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.